Hello, everyone. The stock market has been very choppy lately, and part of this is due to the seasonality effect of August and September are usually the worst times to invest in the stock market historically on a year-by-year basis. Frequently, it's been my experience that the old saying, invest around Halloween and sell around Easter, turns out to be very profitable. I'm considering taking a vacation from stocks until after the election. And speaking of the election, what a tumultuous turmoil that has been. We have had about 3 years worth of history in 3 weeks. An incumbent president decides not to seek re-election. A previous president is almost assassinated, and the vice president becomes the new candidate almost by acclamation and is endorsed by everyone virtually in the Democratic Party, including Nancy Pelosi and the Obamas. There's also the factor that the recent elections, the market has tended to go down before the elections. 3 of the 4 last elections, 2008, 2012, 2016, and 2020, 3 of those 4 elections went down prior to the election. Now, the only election where it didn't go down was 2020, but that was a special case. That was because the market that year had already crashed due to the pandemic. The Federal Reserve proceeded to put trillions of dollars into the economy, virtually ensuring that the stock market would go up and virtually ensuring that eventually we would have terrible inflation, which we now have. True to this pattern, the stock market has gone down for the last 3 weeks. As can be seen from this chart, this 1-week chart of the NASDAQ and the S&P 500, the NASDAQ went down about 2% during the week, and the S&P 500 went down almost 1% on the week. But the big drops were on Wednesday and Thursday, with NASDAQ recovered somewhat, and the S&P 500 recovered somewhat on Friday. I think this was due mainly to the B+ report we received from Google when the market wanted an A+ report, the C report we received from Tesla's earnings when the market was hopeful that it would be somewhat better than it was. The exception to this turmoil has been the Russell 2000. Looking at the chart, you can see that the Russell in the last month has made almost 12%, and it's still not overbought. It's at 67 on its relative strength, which is good. Super Bowl Tom Lee is calling for the Russell 2000 to go up about 15% in August. I'm skeptical of that because of history. If you go back to the 2008 chart on the Russell 2000, looking at that chart now, the Russell was at 845 on October 5th of 2007, right before the big crash of 2008. By February 27th of 2009, the Russell 2000 had gone down to 390. It had lost more than 50% of its value. If there was hard times coming, I don't think small stocks are going to protect you that much. They think that lowering the interest rate is the big impetus behind the Russell 2000 going up. And that's just anticipation of them cutting rates. They haven't cut rates yet. When they start cutting, they'll only do probably 1/4 of a point at a time. Right now, only 30% of the debt that small companies owe is variable debt. So only 30% of the debt they will owe will be lowered. And then it's only going to be lowered by 1/4 of a point. I don't think they're going to dramatically benefit from the interest rates being lowered until you've lowered the rates at least 1%. And that's not going to happen until sometimes in 2025. And if the big caps go down, it's hard for me to believe that the small caps are going to hang in there that well. They may go down less. I think ultimately they're still going to go down somewhat. This is all shaping up to be buying stocks sometime after the election is likely to be much more profitable, in my opinion. There was good news in that the GDP, the gross domestic product, increased by 2.8% in the second quarter quarter, only 2.1% was expected. That would indicate that we're not headed into recession anytime soon. Other indicators that we're not headed into recession soon was on Thursday, the Labor Department reported that the initial jobless claims totaled 235,000 for the week ended July 20th, which is down 10,000 from the previous week and in line with the Dow Jones forecast. Continuing claims also edged lower to 1.8 million. Also, orders for durable goods. Now, this one would raise some concern about a coming recession because it's for generally big ticket items such as aircraft, appliances, and computers unexpectedly fell 6.6% in June when there was a forecast for a 0.3% increase. So this was a dramatically lower number on the durable goods. However, excluding transportation, new orders increased 0.5%. Transportation has been going down, and when transportation goes down, that's usually an indication that the economy is doing worse. So we have very mixed signals on the economy. We have big earnings coming out next week, which will determine whether we're able to resist the negative pull of the seasonality factors I've listed. First off will be Microsoft on July 30th, which is a Tuesday. Next up to bat is Meta, which will report on Wednesday, July 31st. And then we have the double whammy killer on Thursday when we have both Apple and Amazon, which is Thursday, August 1st. I expect these four members of the Magnificent Seven to have results similar to Google. Google had very good results, but their results were not wonderful. Wall Street is demanding that these companies have now because so much was expected. So they will have good results, but they won't be wonderful enough for Wall Street. And so I'm thinking that the market's probably going to go down somewhat. And looking at the chart, you can see in the last month, the only one that has done well in this tech sell-off, and it really hasn't done that well, it's more or less just consolidated, is Apple, and it's made 4.3% in the last month. The other three are all down. Amazon lost 2.1%, Microsoft lost 5.7%, and Meta lost a whopping 8.8%. Looking at 2024 as a whole, the big money I made was all made in the first quarter, and that was due to artificial intelligence. Now the shine has come off artificial intelligence because we're realizing it's going to take longer than we thought it would. This is similar to the dot-com crash, only it's not as bad. In the dot-com crash, it was a theory that these things were going to make money, and they were putting companies up as stocks that really didn't have much of a game plan. The current artificial intelligence stocks are making money right now, and they're going to make money in the future. The difference between the dot-com crash and this pullback is that these artificial intelligence companies will be up and running strong within 3 years at least. It took a dozen years for the internet to come into full fruition where we could see that it was just going to make mega profits. It's going to take less long for artificial intelligence to grab hold, in my opinion. Thank you for watching.